what we would like to see them do is get this done and behind. We think it's appropriate to get a hike done, but we don't want to have to see a hike coming every time they have a meeting over the next 6 months.
You also, were you more bearish than you are now earlier this year?
Yes. From late last year, we were cautious on the market, describing the market as likely to have a 5 to 10% decline rather than advance. But since we've had this correction, we're taking a much more tactically bullish stance. And I do think the market works its way 5 to 10% higher from here by year end.
That just gets us back to where we were.
That's exactly right. We haven't changed our price targets very much. Look, this market is being rightly pushed down because investors are not concerned about GDP. The concern is profits. This is about China, not so much China's economy, although that is a concern. This is about countries and companies that sell to China. That's where the profit pressure is.
What about the profit pressure that comes from what we read about every day? And that's stagnant wages, although there's some hope that maybe you're starting to see a 5.1%. It's lower than it was in any part of the last couple of administrations. So it should be at a point where you should start to see that. That doesn't necessarily help margins.
It doesn't help margins. However, I think the bigger issue is that you do see this disconnect between the economy's profit drivers, investment spending, export activity, manufacturing activity. That's where the connections are to the global economy. That's where the additional pressures come from the stronger dollar. That is all very weak. That's why profits are weak, not so much because wages are going up. That usually is okay for companies too. But the labor market's tightening. The unemployment rate keeps falling, partly good job creation, still record low participation rate. And that's something that's causing us to think the Fed should hike. We'd like to think that the Fed's bigger than, market tantrums. However, if the market throws a massive tantrum and goes into full-blown nasty correction well beneath 1900, I'm sure the Fed will put their plans on pause. But a mere dip of 5 to 9%, we saw a little bit more than 9% decline in 1994. The Fed should stick with their plan. If they think the labor market's tightening, we think they should get the first hike done. Do you get to
feel, in your view, you're retired now, I guess, sort of, oh, not retired, but not a CEO anymore, but you get the feeling that profit margins are peaking or have one?
Solid. There's been huge expansion.
Can they go higher?
And it's selective cases, yes, they'll definitely go higher. Others will
But it's
will
not,
fall.
Because there's a major Wall Street firm, I don't know who it was, one of them over the weekend, made a negative call, I'll look it up, made a negative call on the averages overall. I think it was J.P. Morgan, maybe.
And they've been very bullish,
and
by the way.
that part of that is because margins are peaking or have peaked.
I think margins solid. Costs are in line. Companies have adapted to the global market. I think they're very solid. And look, a quarter of a point, we just need to bite the bullet and get on with it.
I agree with that. I'd like to do 50 basis points to get the next few meetings out of the way.